welcome to my live broadcast here. This is Rodrigo Beltran, also known as RTB The Mortgage Guy on social media and other platforms. So the goal for today's talk is we're looking to explore the world of home equity and how to use that in a responsible way. What are ways that you can access that equity, and is it to your benefit? So before I do that, before I get into the world of home equity and what are some of the smart ways to use it, I want to start off a little bit by talking about myself and what it is I do and how long I've been doing this, how I ended up here. So once again, Rodrigo Beltran, vast majority in the world of loans, finance. Started off working for a large retail bank at the age of 18. I did that for about 6 or 7 years. Made my way into the world of insurance through that same company. Did a little bit of insurance sales as well as insurance underwriting, okay? And then the underwriting world didn't quite go like I expected. A little bit boring if you ask me. So what I ended up doing is I landed in mortgage loans, okay? Very, very exciting world. I actually think that I have found, what it is that I'm good at, and I'm really passionate about what I do. So I'm rambling a little bit, one, because I want you guys to know who I am and what it is that I do. I don't want to get too much into the topic right away. I'm looking at the time here. I'm giving maybe people time to fall in. Kind of just going on about who I am, right? I'm gonna go over here a list of some of the questions that we're gonna, some of the topics that we're gonna cover today. So let's see here. We're gonna talk about how much of your equity you can use, right? How much of that, I like to call it the accessible equity or usable equity, right? So if you're looking at how much your house is worth, you're not always going to be able to touch all of that equity, okay? The lenders, the closer you get to that 100% mark, it's a higher risk for them, right? We're going to talk about how much money you can really save, right? Are these just headlines? Are these, when I say you can save $1,600 a month, is that just to hook you in, or is it real, right? Is that a real thing? What is the process of accessing that equity, right? What type of loans are there? How can you do that? Common mistakes to avoid when using your home equity. And then probably my favorite topic here, I want to go over how to accelerate the payoff of your debt by using home equity. It's probably my favorite, okay? So before we do, I keep repeating myself here, apologize for that. Some other questions here, how to determine how much equity you have in your home. Again, what's the process for accessing that equity? Is using home equity better than taking out a personal loan? How much can I realistically save by using my home equity? Will my monthly payments go down if I consolidate? Are there long-term savings benefits beyond the monthly payment reduction? So these are all great questions, okay? We're gonna get into it. I'm gonna go back to topic number 1 here. How much of your home equity can you use, okay? So this answer is going to be different depending on what type of loan programs are accessible to you. Okay, so in the standard world of insurance, the QM world of insurance, qualified mortgages, the QM world of insurance, you have 3 major loan programs. Okay, you have what's called an FHA mortgage. Okay, you have what's called a conventional loan. Then you have the VA loan. There's also the USDA loan. I'll probably save that for another day. Those are not as common as these first 3. So the FHA mortgage, okay? A lot of people think of this as maybe the option. They're more lenient, the FHA mortgage, okay? So this is a program that most people think of as the low down payment mortgage, right? When you get into the FHA mortgage, it has the ability that you can buy the home with a 3.5% interest, 3.5% down payment, okay? Also, the benefit to the FHA mortgage is that it has a lower FICO score requirement, right? So with the FHA mortgage, they're typically gonna let you access, or they're gonna let your max loan when you're doing cash out, when you're accessing that equity, the max is gonna be 80%. Okay, so the question is, what does that mean? What do you mean max 80%? So what I'll do is I'll use the number of 100,000, okay? Let's just say you have a current loan right now of $60,000, okay? That's how much you currently owe on your home. And the value of that home right now is 100,000, okay? So 80% of that is 80,000. That means that when you're doing a cashback loan, you can do that loan up to 80,000. So after you pay off your existing mortgage, after you pay some fees, some refinance fees, whatever the payoff and whatever the fees are, whatever's left over out of that 80,000 is your cash back. So let's just say after you're paying off your first mortgage and after you pay fees, you'll probably end up using 65,000 with a max loan of 80,000. That's a difference of $15,000, right? So again, FHA mortgage, max loan amount with the cashback loan is 80%, okay? Now, just multiply that, right? Let's just say you have a $300,000 mortgage. Oh, I'm gonna start doing math here in my head. Calculator. Sorry, I'm gonna try to slow myself down here. I have this thing with trying not to have too much quiet time, right? Like no speaking. All right, so bring over my calculator. All right, let's use some more realistic numbers, right? I'm very, very familiar with the Arizona market, okay? Arizona market, these are unofficial numbers, but just based off of what I see on a daily basis, you're typically seeing houses, well, let me see, we got a question here. Can you buy down your interest rate as well? Thank you, Nicole, that's a great question. Yes, you can buy down your interest rate. So the question is that the thing to do? Is that going to be a smart thing to do? So I usually do a calculation to determine whether the buy down is worth it. And I actually really love that you asked that question, Nicole. So, in a world where we have these eye candy, right? Interest rates are that eye candy, right? It's like, well, I got a 5% interest rate. And then my question is always like, how much did you pay for that rate? Okay, so for those who don't know, the buy down is the ability to pay the lender extra money up front as you're making that loan. You pay them extra money to get a lower interest rate. Okay, these buy downs are usually measured in the form of discount points. Okay, so for example, one discount point is 1% of the loan amount. So let's just say if we're dealing with a $300,000 mortgage, 1% of that would be $3,000, right? So if you are paying $3,000 to get a lower interest rate, but that interest rate is only saving you $5 a month, you know, how long is it going to take you to get your money back? You're saving $5 a month. How long is it going to take you? Well, let's see here. So I get $3,000, right? Let's just say that's what it costs you to get that lower interest rate that saved you $5 a month, right? I get that $3,000 and I divide it by 5 because that's what we're saving every month, right? Divide it by 5. That's going to take 600 months, or in other words, 50 years to make back your return on investment, right? To make back the extra money that you paid. It would take 50 years, right? That's not worth it. I don't want you to buy down your interest rate if it's going to take you 50 years to make back your money. So let's just say you paid $3,000 for this lower interest rate, but it's saving you $100 a month. Okay, so we'll do the same calculation here. You get the $3,000, divide that by 100, right? That's you paid $3,000 to get this lower rate, this lower payment. It's saving you $100 a month. So we're gonna take that $3,000, divide it by what we're saving, and that gives us 30 months to make back your money. That's pretty good. As a rule of thumb, I think we typically like to say between 2 to 3 years, right? Whatever your buy down is, if you can make back that money that you paid for it in 2 to 3 years, it's typically worth the buy down. Okay, so in this case, 30 months, that's 2.5 years. It would be worth it. It would be worth it. So I want to circle back around to your question, Nicole. A buy down, it depends. It's like everything in this world, right? It depends. It also depends, like, as you can see here, you pay money to get that lower interest rate. If you know that you're not going to be in this loan for another 2.5 years, right? Because that's what it's going to take you to make your money back. If you know, I'm going to refinance again next year, right? You're saving $100 a month. You made back $1,200 in that year. That other, we're still working with this $3,000 buy down, right? That other $1,800, it was lost because you weren't in the loan long enough to make back your money. So great question, Nicole. Thank you so much for that. I'm going to try to think about where we were going with this. Okay, let's talk about, we were talking about how much of your equity is accessible to you. How much of that can you use, right? So I was going to try to use more realistic home values, okay? So realistically, you're probably looking in the state of Arizona. You're looking at home values, I would say in the $350,000 to $400,000 range, right? So let's just go with 400,000, right? I like to use those nice, solid numbers. 400,000. Your house is worth 400,000, and I wasn't able to get my screen to share today, so I apologize. I'm doing these calculations off screen. If you have a calculator in front of you, you're welcome to whip it out and see if I'm doing this stuff right. I also might edit this later on to have visuals, right? But for the moment, we're working with a $400,000 value, right? So first thing I like to do is I like to see what 80% of that is. What is 80% of 400,000? Because if I have an FHA mortgage, my new loan, if I'm taking cash out, my new loan, it can't be more than that 80%, right? So 80% of 400,000 is $320,000. Okay. How much do you owe on this home? You owe $200,000. Okay. So subtract that $200,000 from this number that we have, this 80% number, which is $320,000, and that gives you $120,000 of accessible equity, right? Hope I'm not over explaining here, but I want to make sure that people are following. So we had a $400,000 home. 80% of that is $320,000. In this scenario, the person owes $200,000. So we're going to subtract that from the $320,000, the 80% number, and whatever's left over, that is your accessible equity. Okay. For the conventional mortgage, it's a little bit higher. Okay. So conventional mortgage, what's appealing in this mortgage, a lot of times, not always. Sometimes in this market, I don't want to get too much into this, but in this market, the appealing thing to the conventional mortgage is that a lot of times these houses that are only available for conventional loans, sometimes they have a more leniency on the inspection of the home. Meaning, if there's like when the FHA mortgage, if the house is available for an FHA mortgage, that's another thing. They go through what most of us perceive to be a stricter inspection, right? It's harder to get it to qualify the inspection on an FHA mortgage, right? So if there's a house that is qualified for both FHA and conventional, there's more buyers, right? There's more people trying to buy that house because, again, the FHA mortgage has people with lower credit and lower down payments a lot of the times. So you got the people who qualify for conventional, you got the people who qualify for FHA, and then all the other loan programs, right? They're all trying to buy these houses. So you have a house that is only on the market for conventional mortgages, there's probably less competition, less buyers, right? Mind you, there might be other issues with the home because the conventional inspection is sometimes more lenient. The other thing to the conventional mortgage, in certain markets and certain economies, they might have better interest rates, although that's not the case right now. So that's not the purpose of this chat today. I'm going off on a tangent. Conventional mortgage. In a cashback refinance on a conventional mortgage, the max LTV is slightly higher, just a little bit. That number is 85%. Max LTV is 85%. Okay, I'm gonna take a quick drink of water here, guys. All right. So if you remember, in this scenario with the $400,000 loan, okay, the 80% mark meant that our max loan amount could be $320,000, right? For this same home, if you qualify for a conventional mortgage, you just have to have a little bit of a higher credit score, right? And again, I don't want to get too complicated here. There's an automated underwriting system. The underwriting is basically the rules and regulations, the guidelines. So there's a lot more that goes into the qualification of these loans, but a lot of times we're looking at just the credit score, right? So for conventional mortgage, a lot of times you need to have a 620 or higher. Let's see here, got another message. All right. And for this, let's see here, I'm losing my train of thought. Okay, $400,000 mortgage, okay? 85% of that would be $340,000, right? Versus the $320,000 on the FHA mortgage. So accessible equity on the conventional mortgage in this scenario is $20,000 more, okay? For our veterans here, okay? For the VA loan, really cool thing about this loan, max LTV, okay, 100%. So I want to make sure you heard me there. 100% max LTV on a cashback loan for veterans. That's amazing. That's awesome, and I think it's great. Don't want to get all corny or nothing, right? But veterans definitely deserve that. But it's, you know, my main thing here is I want veterans that are watching to know. I want you guys to know this. The max LTV for you is 100%. So same scenario here, $400,000 mortgage. You can draw up to $400,000. Your new loan could be up to $400,000, which is amazing. So with all that being covered, I am going to move on here to the next subject here, okay? I also want to point out that as I upload this for people who are watching this in the future, I'll probably end up in the comments maybe putting, you know, timestamps on what I'm covering and when I'm covering it, right? If I'm being kind of long-winded, you can just skip forward to the part that is interesting to you, right? Or the part that you wanted to cover. So let's see here. I think I lost my page. Sorry guys, bear with me here for just a moment. All right, so we went over how much of your equity you can cover. The next question is, how much money can you really save? So if any of you guys have seen some of my advertisements, I'm pointing out to a lot of people that you know, you can save upwards of $1,000 a month. Okay, those are real numbers. I have 2 case studies here. Again, when I upload this, I'll probably have better visuals when I, you know, edit it in the future. But I want to show you here. I'm just going to show it to the camera. You can maybe pause or screenshot later on, or again, if you're watching this in the future, you can. I'll probably have some visuals for you. So this case study here, I'm gonna put my finger here as I turn away. You'll see at the top. Okay, let's see here. I got the screen on reverse. Apologize, guys. So this right here, this is the savings right here, right? Total savings per month, total savings per year. Okay, these up here. See here. This up here, it's nothing too crazy, guys. This mortgage, the original mortgage was $228,000. Their mortgage payment was $1,200. Okay. Their other debts, okay, it amounted to $120,000. they were paying $3,000 a month for their other debts, right? So this is an assortment, credit cards, auto loans, you know. I got those debts here on the back. You want to leave that, I'll just leave that there for a moment. You can make sense of what these other debts are. You can see, you know, just some credit cards and nothing too extravagant, nothing too crazy, right? So again, other debts here, $120,000 of other debts, $228,000 on their mortgage. Total this individual was paying $4,349 a month, okay? This, if I remember correctly, this individual had more credit card debts, right? Here's another breakdown of the debts. So you can see what that is, right? There was a HELOC, that's a payment on the HELOC. They were paying $2,000 a month in credit cards, $469 a month in installment loans, and again, the total $4,349. When I consolidated this individual, we brought them down to, we did a max loan amount of $368,000, and if I remember correct, for this customer, not only did we pay off all of their debt, but we got them about, I think about $13,000 of cash back, okay? And their new monthly payment, remember, everything is consolidated. It's all one single loan now. $2,735, right? That means we're saving them $1,614 a month, or they just got a $19,000 a year raise, right? That's what I like to say. I like to say they got a raise for for whatever they're saving. That was their raise for the year. It's another way of looking at things. Down here, again, I apologize that the screen is mirrored. It's in reverse. These are calculations. I want you to see, some people say, well, you're just stretching out that debt over 30 years. That's not smart. I'm like, well, you don't have to, right? First and foremost, you're saving $1,600 a month, which is, you know, giving you the ability to not get further in debt. That's huge. That's a big deal, okay? What happens if they reinvest all that savings back into their mortgage? Well, the calculations on this one, they would be debt-free in 10 years, 11 months. The entirety of their debt, they would be in, so basically they would be paying exactly what they were paying before, except for they'd be paying it towards their mortgage now in one single consolidated loan, right? If they reinvest their savings back into the mortgage, they would be debt-free in 10 years, 11 months. These are real calculations, guys. These are not extravagant numbers. These are numbers that happen often, okay? I used to work with a particular company. The reason why I consider myself a debt consolidation, a home equity specialist, because this lender that I was with, this is what I did. I spoke to people about their equity and how to put it to good use. And these types of numbers that I'm showing you were often, I'm talking 80% of the time, pretty darn often, especially if you're paying off your debt, right? If you're paying off other high interest debt, such as credit cards, right? Well, I want to save a little bit of money, right? So in this particular down here, you'll see what happens if they reinvest half of that savings back into their new mortgage, right? So they would pay the $2,700 plus half of what they're saving, right? So about $800. They would still be debt-free in 15 years, 7 months. 15 years, 7 months. Okay, this is a full debt consolidation situation here, where first and foremost, we saved them $1,600 a month, stopped them from getting into more debt. And second of all, we provided them the opportunity to be debt-free in as little as 10 years, 11 months. Big deal, guys. show you guys one more case study here, okay? This is kind of the opposite as far as what the debt was, okay? So in this particular situation, the loan amount was $117,000. The total other debt was $113,000. I'll show you what that other debt was in a moment. And the sum of all their debt, including their mortgage, what they were currently paying was $3,450, right? That's what this customer was paying. So I'll flip this around real fast and show you what the other debts were, okay? Let you get a quick look at that. Let you read it in reverse because my screen is backwards. So let's see, right? There was an auto loan, a couple of small personal loans. I think one of them was like an ATV or something. And then credit cards. Nothing too crazy, just a bunch of small credit cards, right? So flip that back around. It was $113,000. Their total monthly expenses were $3,450, okay? So what did we do? We made a new loan. We consolidated everything. The new loan was about $259,000. Their payment amounted to a little over $2,000, which means that we saved them about $1,300 a month, right? Or in other words, $16,000 a year. Keep things really simple. What happens if they reinvest all that savings, right? What if they reinvest that $1,300 back into the new mortgage? This customer would be debt-free in 9 years, 8 months. What happens if they only reinvested half of it, right? Maybe they wanted to actually save money. They would still be debt-free in 14 years, 3 months. Big deal, you guys. Like I said, this is nothing out of the ordinary. This is common, right? So I offer to anybody who's willing to speak to me, okay? I offer them the opportunity to let me do these calculations for you. Let me see what will happen if we consolidate some or all of your debt, right? What would these numbers look like? What would your monthly savings be? Okay, and then what would the savings be if you reinvested that back into your mortgage? So one of the questions here, I'm just gonna skip ahead here because I think one of these questions is relevant. Let's see here. Okay, was the last question here. Are there long-term savings benefits beyond monthly payment reduction? And the answer is yes, 100%. Let me see what one of these questions here. Can you also amortize your payment later if you have a lump sum of funds? Yes, of course. So I think what Nicole's trying to ask here is, what happens if you pay it off sooner than later, right? So I particularly don't know of, we're talking about standard refinances here, right? Standard, again, what we call QM mortgages. Do they have any early payoff penalties or fees? And I personally don't know. There might be some out there. I don't know that there are some, but let's just say in most cases, 90%, whoever you're dealing with, you can ask. That's a great question to always ask, right? Are there any early payoff fees or penalties, right? So to answer your question, Nicole, in most cases with most lenders that I know of, yeah, you can pay it off early. The other question that you might be asking, Nicole, I'm trying to remember. This is kind of slipping my mind because I think you're telling me here that it's called. I'm not remembering what the term is called. There's a term for this, Nicole. Basically, if you put whatever your balance is, right? If you put a large sum of payment down, you can have your payment recalculated. Okay, I think that's the question that you're asking, and the answer is yes. As long as the large sum of money that you pay, Nicole, as long as it's a certain percentage, you can have the payment recalculated. And I think that number, if I'm remembering correct, is 10%. If you do a large payment of 10% or more, you can have your payment. Now just know that it's your minimum payment, right? You can always pay more. You can always voluntarily pay more. But your minimum payment will be recalculated based off of how much. Yes, there it is, Nicole. It's a mortgage recast. So your payment will be recalculated based off of what the balance is, the remaining balance, and what the remaining term. So if you got 25 years left on your loan and you paid $50,000, just a large lump sum payment, they'll recalculate it based off whatever's left over. Another great question. So I wanted to do a quick calculation here. We'll use these scenarios here. I'm gonna use the first scenario here, the individual that had a lot of credit card debt. Okay. Please do not be sorry, Nicole. These are amazing questions, because not only are these questions that other people more than likely have, they help me to not ramble, because I'm actually speaking to something. I'm trying not to ramble. I got about 20 minutes left here, so I think I want to use maybe like another 10 to 13 minutes to show you how much to answer this question here. Let's make sure the question is fresh on everybody's mind here. Are there long-term savings benefits beyond the monthly payment reduction? So I'm gonna answer this in a simple format to drive the point, and then I'm gonna show you what the numbers are. With any loan, okay, the faster you pay it off, the less interest you pay. Okay, that goes with any loan. You might have a crazy loan with a 20% interest rate, but if you pay it off in a month, right? You pay it off in 2 months, that 20% interest, it didn't cost you a lot because you paid it off really fast, right? So the answer to this, are there long-term saving benefits beyond the monthly payment reductions? Yes. If you can, like in these scenarios, if you're paying off your loan in 10 years, 11 months, right? That's only 10 years, 11 months worth of interest versus 30 years of interest, right? So I'm gonna show you, I'm gonna put these numbers into my calculator right now, okay? So for this individual, the loan amount was $368,335, okay? 368, 335. Don't quite remember what the interest rate was on this scenario. I'm just gonna use about 6.5. It was probably lower than that, but I don't like to, use exaggerated low interest rates. So with a 6.5%, we're showing the scenario what the long-term savings benefits would be if they reinvested their savings, which would be $1,614. Okay, so I want to show you. If you go 30 years on this particular scenario here, the total interest paid over those 30 years is about $469,000 of interest. Okay, a lot of money, a lot of interest. If you reinvest that savings and pay off in 10 years, 11 months, the total interest paid over that 10 years, 11 months is $146,000. That's a lot of money saved. It's over $250,000. Let me do the math here. The interest paid reduced from $469,000 to $146,000. This person would save $323,000 worth of interest if they reinvested their savings. Again, you're talking about money that they were already paying. They were already paying over $4,000 a month. They're already doing that. You refinance your mortgage, you consolidate everything. You keep paying that number, you're debt free in 10 years, and you save $323,000 worth of interest. Now, for people who are in the position to do that, that's awesome and amazing. If you're not in that position, still realize that, you know, we live in the here and the now, you know. It's awesome if you can do it. It's awesome if you can pay off your mortgage in 10 years. But if you can't, think about the fact that the savings that you created on a monthly basis is stopping you from getting into more debt. Again, an installment loan. So an installment loan is any type of loan that has a fixed payment and it's going to pay off in a certain amount of time, right? Anytime you're taking credit cards with 22% interest rates, and you're bringing that into an installment loan, you're always better off. You're always better off. Again, like this person right here, their credit card debt, where's the number here? And I didn't put the max. Okay. I don't want to do all that math right now, but again, let's just put it to you this way. I always like to say, if you have $30,000 worth of credit card debt, consider that, in my opinion, it's just the way that I drive the point across. Consider that 3 times as much if it was an installment loan. So if you paid off $30,000 of credit card debt, pretend like you paid off $90,000 of a installment loan, of a personal loan or a car or whatever. Paying off credit card debt is huge. I mean, if you're making a minimum payment on a credit card, it might not ever pay off. Or if it does pay off, it's gonna be, I mean, I think like probably 80 to 90% of your credit card payment is going towards the interest. Very, very little, if any, is going towards the actual money that you owe, the actual balance. Okay. I'm gonna go over a few more questions here. I don't know if anybody's gonna tune in or if there's gonna be more questions, but I do have some advanced questions here. We answered the fact that there could be other long-term savings, long-term benefits. Let's see here. How can I determine how much equity I have? We went over that. What's the process of accessing home equity? The process of accessing home equity. I mean, I'm still going to answer the question. I feel like most of you might be aware. You could do a cash out refinance. Basically, you get an entirely new loan that pays off your old mortgage, and then you make this loan a little bit higher to allow for some cash back. That's kind of what we've been talking about here the entire time, right? The other way to access your equity, you have second mortgages, right? And then you have two other types of loans. You have what's called a home equity line of credit and a home equity loan, okay? So home equity lines of credit, home equity loans, they're a great product. Some people like to, I like to think that the time to get a home equity line of credit or home equity loan is if you have like a plan to pay that money back fast. I like to think maybe like within 3 to 5 years. I mean, that's just my personal opinion. Some people are gonna have different opinions. Why do I feel that way? The home equity line of credit is very attractive. In most cases, it's attractive because they have a lower payment, and because you don't have to touch your primary mortgage, right? A lot of people are very in love with the fact that I have my first mortgage is good, I don't want to mess with it, which may be true. You know, that's why I always say to people, when I give you a consultation, let me run the numbers and let's let the numbers speak for themselves, right? Let's see if it works out better by doing the cash out refinance and by consolidating. It might not. And if it doesn't, I'm gonna tell you, I wouldn't do this loan, right? It's my fiduciary responsibility to let you know. Let's see here. Let's make sure I'm not going too off on a tangent here. So home equity line of credit. Yeah, very appealing because they have lower payments. But I think where people get themselves in trouble is they tend to forget that that home equity line of credit, like Nicole just mentioned, a lot of times they have what's called a variable interest rate. So you'll usually, it's not variable in the sense that it's going to increase or change all the time. This interest rate usually changes with the economy. I believe the Federal Reserve puts out a base rate, what they call prime, and then you'll usually pre-negotiate the agreement, like prime plus 2.5%, right? So if the prime is 10 and then your plus is 2.5, then you have a 12.5% interest rate. If the prime drops to say 8% plus your pre-negotiated 2.5, then your interest rate would be 10.5%. But where I think that people usually get themselves in trouble, I'm gonna take a drink here, people. Get themselves in trouble because on these home equity lines of credit, a lot of times they have a smaller interest payment, a smaller minimum payment. The reason that payment's usually smaller, even though you have a higher variable rate, is because a lot of times these HELOCs are interest-only payments. They don't require that you contribute towards the principal. And so what a lot of times people end up doing is they'll have this home equity line of credit for 10 years and they'll never have paid a single dime towards the principal, meaning you never brought down the balance that you owed. So imagine you just paid 10 years of interest and you never paid down the balance a single bit. And if you remember what I told you guys earlier, the best way to combat a high interest rate is to pay it off fast, right? So not only did you have a higher interest rate, but you just paid 10 years of interest without paying it down a single penny. So I think a lot of people get themselves in trouble with HELOCs. You know, if you're doing the math, you're losing a lot of money. Oh, 1 second here, lost my screen. There it is. Again, it's a great product, great loan. I just think that you need to have, it's like anything, right? You need to have a plan. You need to know how fast you're gonna pay off that money that you're. So like the home equity line of credit, think of it like a credit card, right? Difference of a line of credit and a credit card basically is lines of credit allow you to, I don't know what the official definition, but lines of credit allow you to draw actual cash. Like you can go to that company and say, or you can, well, sometimes you're getting a line of credit from a company that's not a bank, but you can write checks, right? You can write a check, and you can deposit that check into your account with a line of credit. You can kind of use a line of credit like a checking account, kind of. So again, line of credit, I'm gonna circle back around here to the question because I think I've been rambling for too long. What are the process of accessing your home equity? Once again, cash out refinance, second mortgage, home equity lines of credit, home equity loans. Home equity loan might be a little bit better than the line of credit. There's a little bit more I can explain about the line of credit. They usually have what's called a draw period. It's usually about 10 years. After that draw period, it turns into like a 15-year loan. So they're usually about 25 years. You know, depending on who you're going, there might be minor differences, but depending on who you're going with. Okay, guys, we're making good time here. So 6:51. We've been talking here for about 51 minutes. I'm gonna try to use up the full amount of time here if you guys want to hang out with me. I'm always happy to hear more questions. So next question here. Is using home equity better than taking out a personal loan? You guys know the answer, right? Depends, right? I would say the time for a personal loan. First of all, personal loans, you know, I'd say the personal loan is great in smaller numbers. You know, maybe you're getting a $5,000, a $10,000 personal loan, right? When you start getting up there, say up into these scenarios here with these individuals that were paying off $120,000 worth of debt, $113,000. I mean, even if it's just $60,000 or $80,000 worth of debt, probably not going to want a personal loan for that, because the interest rate on that personal loan is going to be a lot higher. You're talking about, so I'm going to circle back around to this. These lenders, the way they determine what the rates are going to be is how big is the risk for them, right? So you're talking about a secured loan, right? That's what mortgages are. That's what car loans are. They're secured, meaning they're secured by the asset, by the car. Meaning if you don't make that car payment, they're going to take back the car from you. You're not making your mortgage payment, you're gonna foreclose or something along those lines, right? Those are secured by the asset, where a personal loan is an unsecured loan. So therefore, they're gonna have higher interest rates. So again, I think the simple way to look at that is, if you know, depending on the dollar amount and how fast you plan on paying it back, because again, talking about how fast can you pay back the loan. Right? That always combats a high interest rate. It always, you know, the faster you can pay it off, the less the interest rate matters, right? Next question here. How much can I realistically save by consolidating my debt? I think we already covered that. You can save, you know, in these scenarios, upwards of $1,600 a month, $19,000 a year. Will my monthly payments go down if I consolidate? So, you know, this is a good question here, right? Your mortgage, you know, you have to consider the entirety of your debt, okay? So in these scenarios, the entirety of the debt was $4,349, and it went down. So because we consolidated everything, their total monthly expenses went down. But I mean, if you're talking about the mortgage payment, yeah, the mortgage payment went up, but their monthly expenses went down. So just want to be clear on that, okay? Will my monthly payments go down if I consolidate my debt? Your total expenses will go down. Your monthly payment will go up because you're putting everything into one single payment. Yeah, I think that's pretty good. I think we've answered a lot of questions today. I hope that you found some value in this live stream today. This was my first one. This was my first time doing a live stream like this. I look forward to improving. You know, what I specialize in, the product, right? The loans, helping you make the best decision. This live streaming stuff, I'm new at it. So what I look forward to doing is, you know, learning how to screen share, learning how to make it more visually appealing to you, and learning how to get more people to join in. I mean, I'd like to see these types of talks grow. I really believe that that this is a big need for the country right now. You know, luckily, home values have held strong. So for those of you who have owned your home for, I would say, 3+ years, chances are you got a pretty good amount of equity in your home, right? So home values have held strong. So, you know, congratulations to you if you've been a homeowner for 3+ years. And everything else has gone up. You know, inflation, the corporate world, I don't want to speak like a pessimist, but, you know, they've either had to increase their prices to get more in our pockets, or they found out a way to increase their prices. I don't know which of the two it is. But inflation is high, debt is high. So how do you get that debt? Because it's already there, right? Everything we've talked about today is not really about creating more debt. It's about restructuring your debt. And based off of these scenarios that I'm sharing with you guys, one of the smartest ways to restructure that debt is to consolidate it. And as we just discussed, using a secured loan, right? A mortgage is a secured loan, benefits you because you can consolidate that debt and you're going to get better interest rates than if you had a personal loan, right? Because it's a secured loan. Thank you very much, everyone who tuned in. I'm looking forward to doing this more and more often. We'll cover other subjects, right? The company that I work with, they give me access to over 200 lenders, right? We can do all different types of loans. We can do investment loans, right? So you're talking about rental properties, and we're doing all different types of investment loans, fix and flips. We can do the DSCR loans. We can talk about, you know, buying you a second home. We can talk about, we could talk about anything that it regards buying a piece of real estate. We can go over. So we can talk about how to buy a piece of land and how to build a property on that. What would that take? Yeah. So don't want to go off for too long, but once again, thank you everyone for tuning in, and thank you for everyone who's watching this in the future. We're gonna have a comment section. You're gonna be able to leave questions in the comments. So even if I didn't get to answer your questions on this live broadcast, I can always answer your questions in the comments, or we can also schedule a live consultation. Okay, that's the goal here. So appreciate everyone. I'm gonna go ahead and click the finish button here. Pleasure speaking with you guys. Have a blessed day.